Now for the rest of the day's news on the local markets, I spoke to Martin Lakos at Macquarie Private Wealth. Well, Martin Lakos, a firm lead from Wall Street. What happened locally?
Tiki, good evening. Yeah, look, a good lead from Wall Street. Closed up 100 points on the Dow Jones, was up about 170 points at its best. Certainly was the main drivers where we saw industrial production growth up almost double that expected for July, up 1%. We also had good numbers coming out of Home Depot and Walmart on their retail side, and guidance a little bit better. And also then we had the news out on the bid by BHP for potash, which obviously got the market a bit excited about M&A activity going forward. Our market really vacillated in a smallish trading range, but very big volumes. Over $7 billion traded, with the BHP the largest there at about $1.5, $1.6 billion traded. Behind that, Rio just under $500 million. So big turnovers in the resource sectors. Banks certainly performed quite well, as did our own consumer staples, probably reflecting the better numbers out of the US on Home Depot and on Walmart.
Now, I see Westfield Group's results have given us a look at the retail sector both here and offshore, and we've got David Jones with some quarterly sales numbers out. So what's your take on the retail sector?
Yeah, look, the Westfield result is actually in line with expectations, but certainly does show up that Australia is still performing very, very well, particularly in terms of vacancy rates, which are almost negligible. The UK the same, with vacancy, or should I say occupancy, at 98.8. The US has been soft for them at 92.9, but there was a modest improvement, and they're certainly seeing some improvement coming through. Now, that's also being reflected here in Australia by the David Jones quarterly sales result. Sales up about 7% for the quarter. That's about 3.5% for the full year. They had a bit of a slow start in May, but June, July certainly saw a pick up, particularly in apparel and electronics areas, and they're now starting to invest in inventories, which is certainly suggesting they see conditions continuing to improve. And David Jones' guidance was that they're going to maintain their profit outlook for 5 to 10% growth. That stock was up about 14 cents on the day.
Blood products leader CSL also put their results out and announced a $900 million share buyback. You'd expect that to be positive for the stock, wouldn't you?
Yeah, you would do, but the market didn't like the fact that the guidance for 2011, in fact, was below expectations in terms of the range. They've downgraded the range to $980 to $1.03 billion. Market was expecting about $1.09 billion. Now, that's sort of fiddling with the numbers to some extent, but it does give the market a bit of a feel that there's possibly not the earnings growth coming through into next year. But I think what you've said is right, Tiki. There was a better payout ratio on the dividend. We certainly saw better numbers coming through from in line with expectations across their whole product range. The only disappointment was Gardasil on the sales side, and then they put in a $900 million on-market share buyback, which will give the share price some support. But the stock was down over 80 cents an hour trading day.
And briefly, there are some suggestions that companies both in Australia and on Wall Street are hoarding cash in rather uncertain times and may actually be running rather lazy balance sheets.
You know, it seems the markets have forgotten that the US reporting season for the last quarter was actually very, very strong, both in terms of earnings, but also it does appear there's about over $800 billion of cash across balance sheets in the S&P 500, gearing roughly around 30%. So it's not that the companies don't have the capacity to invest in businesses, just not the intent. Clearly, it's all the areas of uncertainty. Possibly this M&A activity that's starting to pick up might inspire some further investment. That's not a similar case here in Australia, where, although we're going through a reporting season, average gearing on Australian balance sheets is about 32%. So once again, Australian companies have the capacity to invest. They're just not doing it yet. But maybe after the election, we might see that management decide that they can start moving in and looking at interesting assets.
Maybe some more action to come. Martin Lakos, thank you very much for joining Late Line Business.
My pleasure. Thanks, Tiki.